Hello and welcome to a fresh new edition of Bazaar Morning Call. I am Prashant and with me are Sonia, Shenoy and Nigel D'Souza. Guys, hi. Good morning.
Good morning.
We start this morning with pretty decent global cues. The breather in the global equity market continues. The S&P 500 is on a gaining trot, I would say, for 3 days in a row. I mean, despite last night's 0.25% cut, I would count that as flat. The story with the overnight was not the 0.25% cut, but the fact that the S&P recovered 1.6% from the lows. So you are basically coming up this morning reacting to the S&P, which is up almost 3%. You're reacting to 3% on the US market side. And why is this important? In the face of negative news flow, equities overnight ended flat. There was the ISM services index, which was strong. Manufacturing was weak, but what's important for the US is services, and that came in strong. There was hawkish Fed commentary from usually dovish Fed members, and we'll talk more about that, which pushed back against this entire pivot thesis. And there has been a large cut in OPEC production, which has pushed up oil prices. In the face of all of it, US equities, by close, they were down 2% at one point, more than 2%. They ended absolutely flat, and I would rate that as a pretty good outcome. On the back of all of it, this morning, the SGX is indicating from the last close, yesterday was a holiday, almost 120, 130 odd point higher start. So that's basically the rate on your screen, 17,435. Guys, hi, good morning.
Hi, morning, Prashant. And let me also welcome Nigel on board. From now on, Nigel's going to be with us on Bazaar and going to, partake in all the madness, all the chaos. So, Nigel, welcome.
Well, thanks a lot for that, Sonia, as well
Welcome
as Prashant.
Board,
It's a childhood dream, right, in our profession to open market or open the batting for the team. And irrespective of where you bat, you're just giving your best. But
absolutely.
I'm very happy to be here and looking forward to participating in the party, as you said it.
Okay, the party goes on, right? I feel that perhaps in the market as well, the party could continue for the Indian market. Just look at the data, right? As Prashant was also pointing out, now global markets have stabilized a tad bit. FIIs and DIIs bought in the cash markets on Tuesday. So FIIs bought about 1,300 crores, DIIs bought 950 crores. And the Nifty has held on firmly to the 200-day moving average of around 16,870. Now, in fact, that 17,200 mark that we were knocking on the doors of and we slipped from in the last many weeks, that has been conquered as well on the upside. So for now, looks like this uptrend will continue. There was a sharp rally that we saw in the US markets on Tuesday. There was a big intraday recovery on Wednesday in the Dow. And, the labor market data was very strong. 208,000 jobs added in private payrolls. The ISM services index showed a solid growth in the US. So I think our markets fall less when global markets fall and they rise more when global markets are stable. Perhaps that could be the way forward today.
It looks like it. When markets and prices do one thing and data is telling you another, I think you should follow prices. If you're trading especially, and I think that could be the case today as well. I actually went to sleep looking at the market down 2%, a little over 2%, and we woke up with a 0.25% cut. That's a big recovery, which I think could mean that this global bounce could continue. That's point number one. By the way, on the Nifty, and this happened on the last trading session, that is Tuesday, has almost filled an important gap, which was made on the 26th of September. That was between 17,196 to 17,291. Intraday, the market crossed 17,300. We ended slightly under 17,291, but that gap has been almost filled. You can look at resistance. There is a resistance at about 17,350, 17,400, which most would focus on. But to my mind, the bigger resistance from here, if the market continues its upward journey, supported by fairly decent global cues, given what we had overnight, is going to be that trend line. The trend line which is falling from the all-time high of October last year. And on that trend line, the level to watch is 17,650. It is some distance away. It is almost, 350 odd points away. That is a big, meaningful resistance which you got to set your sights on. The impulse remains to try and buy the dip. I think there is no change in that. Banks and financials remain the strongest corner. Look at, the quarterly updates from bank after bank. The latest, of course, is Bajaj Finance, AU Bank, and many others. Loan growth especially is firing on all cylinders. And I think banks remain very, very strong. The big risk squarely comes from any wild moves. And we've had more than our share of wild moves in global equities, global markets, both in rates, which is the bond market, and equities as well. What could be the risk? The risk was data coming in much stronger than expected and kind of Fed pressing on with rate increases. But to be fair, excluding housing data from the US indicates that economy is just about fine. I mean, it's not like sort of firing on all cylinders. It's not collapsing. It's just fine, which kind of maintains the status quo and at the margin gives the hope that if this data starts to soften a little bit, the Fed could take its foot off the pedal. And in that context, tomorrow's jobs number becomes very important. I think it's the most important number before the November FOMC. Watch oil prices. And this is important for India because what has happened? OPEC has announced the most significant cut in production since pre-COVID levels. The US has stopped releasing oil from its strategic petroleum reserves and crude is inching up. We're at, I think, at about 93.5. But if it crosses 96, you basically would end a 4-month downward sloping channel. You basically would come out of, the level to watch is 96. You essentially would have an impulse to buy oil at the 96 or beyond the 96 kind of levels. And given the latest numbers that we have, the exports data, I mean, even the non-oil, gems and jewelry data, you need help from lower oil prices. And that, I think, is the only dampener, not a dampener right now, but something you need to watch out for, which could give us pause for thought. So that's where we're at. Nigel, what are you watching?
Well, we would have been happy actually. We had a trading session yesterday. I'm sure it was a happy Dashera, but the cues last morning was much better. That's the way I would put it. But the data points as well that did come in post Tuesday's rally, well, it was fairly good. The institutions were buyers, and that's the first time both of them were on the buy side all the way in the last 1 month or so. And the FI net buy number, that was the best that we got in the last couple of weeks. So the institutional numbers look pretty good. On the bulls wish list would be either the FI sell less or they buy at least. That would be pretty good news. The FNO side of things, well, we have a live indicator. That's the premium on the Nifty. Well, that expanded in Tuesday's trading session, telling you there was some long addition. And that's precisely what the FIs did. Remember, they were net short on the index. They continue to remain net short on the index, but there was massive short covering, 30,000 short contracts getting covered out, and there was some mild long addition as well. So in terms of them being net short, they're at around 81% of their positions still on the short side, though that's come down from around that 87% odd. They were short covering both on the Nifty as well as the Nifty Bank because the open interest was down 5 to around 8%. The biggest positive, though, for me is the writing of puts. Yes, on Tuesday, they wrote close to around 60,000 put contracts. And the most active strike was the 17,200 put, which the premium was in that vicinity of around 60 to around 70 rupees. So that's heartening to see. How do you approach trade today? Well, the SGX Nifty suggesting a bit of a gap up. You need to compare the SGX Nifty with the Nifty futures. So that's roughly around 130, 140 points gap up. Now, we're going to be starting closer to around the congestion zone. That's with the 20 DMA and the 50 DMA. So the number should come up for you. Resistance zone will be at around 17,450 to around 17,500. That's because of the 20 and the 50 DMA. On the downside, though, since the 17,200 puts saw a fair bit of addition, I think the 17,150, 17,200, that'll be a first level of support. How do you approach trade, though? Maybe if you have a long position, either you're sitting 100, 200, 300, 400 points of gains. So take some money off the table if you get this gap up of around 140 odd. And re-entering, that could be a prudent strategy at lower levels. And I think there will be an intraday dip today. It's also weekly expiry, so things will be a little bit more volatile. Sonia, what else? And
a little bit more exciting, right? I mean, it looks like the market base has moved to that 17,200 level because we had come off from that level a few times and now we conquered it. Yes. So let's see, the US futures are also indicating a start in the green. But there are so many events to watch and, of course, crucial from a market standpoint. One is the September jobs report that comes out tomorrow, and it will be important to see. So far, the labor market data, the ISM data has been solid. Let's see how this one pans out. But for us, earnings season begins full-fledged next week. We kickstart with TCS on Monday. There's Wipro and HCL Tech on Wednesday. Infosys and Mindtree on Thursday, followed by Bajaj Auto and HDFC Bank. So plenty of market-specific, cues, data points is what you're going to get. But purely for today, the SGX Nifty, the adjusted SGX Nifty indicating that the start will be well in the green. Lots of opinion coming through as we kickstart Bazaar this morning. First up, we have Hiren Ved of Alchemy Capital, who says the Indian market has been held back because of challenging global macros like high inflation, record energy prices and slower growth. But the undercurrents in the Indian market are strong. Given this resilience, if things turn around globally, he believes our market could break out into a new high very soon.
Well, let's get you some money market views now. This is Kunal Sudani of Shenoy Bank, who says that the U.S. economic data surpasses expectations. The focus returns to non-farm payrolls that we were talking about. Risk-off flows returned amid tensions between Europe and Russia. The dollar index finds support at 110.2 levels. For the USD INR, 81.25 acts as a support, while 81.75 is a resistance.
All right, and on the bonds, Dhaval Dalal of Edelweiss says that bond prices rallied smartly on Tuesday despite hawkish comments from the US Fed and an uptick in crude oil prices. Expect prices to give up some of their gains today amidst higher US Treasury yields and some clarity on index inclusion. The 10-year bond yield is expected to trade in a range of 7.35 to 7.45% in the near term.
Well, we have a lot of stock-specific action to track today, and we'll get to that in just a bit in our top 10 segment. We're looking at Zee Entertainment, you have Bajaj Finance, RBL Bank, AU Small Finance Bank, Indiglobe Aviation, SpiceJet, ONGC, as well as Oil India. Now, those are on our radar on the back of positive news flow. We also have Godrej Consumer and IEX. They are stocks that are likely to open up in the red.
All right, Mark Matthews of Bank Julius